Hey guys, welcome back to the channel. Just want to go over the New York Open today on Wednesday, May 24th. Before I do that, let me throw up the disclaimer. Okay, so before I throw on some markings on here, I want to give you guys a chance to look at the chart and see if there's anything that pops out at you. So I'll give you a couple seconds here. Pause the video if you want. Look at it. One question I'd like you guys to answer in the comments: do you guys like this crosshairs, or do you guys like just the arrow? Okay, I kind of like the arrow, but I don't know. So comment below, arrow or crosshair, and then I'll just start using whatever everyone likes the best. So here, when we started this range, like I say, this dark gray is the 30 minutes from 9:30 a.m. Eastern Time to 10 o'clock. 10 o'clock starts the silver bullet hour, but this darker range here is the 9:30 to 10 o'clock, the opening range, okay? First 30 minutes. So what do we see here? Price came up, took out this high, right, this short-term high right there, but where'd it come up to? It has a fair value gap here right above those candle bodies, stop right there, perfect precision right there. Comes in, taps that, and price comes down. Would I have taken that as a trade? No, because it just started at 9:30, and I don't trade before 9:30. So that's just where price went. It's nice to see that it's respecting a fair value gap. Having it respect this fair value gap and coming down, taking out lows down here, that's telling me that we are bearish. So then we see that the short-term lows were taken out here. We go all the way over here. And then it creates a fair value gap right here. Let's name that a fair value gap just so you guys can see it. Make sure you see it on there. Price comes down, comes back in. You could take your trade here if you wanted to. If you could enter it right at the start of the fair value gap, your stop would have to be above this candle right here. So it's right there. It's one tick. It's five handles. You go to 2 to 1. There's 10 handles right there. Okay, now if you want to do 1 for 1, you could have gone right there. Would have been in the middle of these two new week opening gaps, which would have been fine. Shoot for 10. After 5, I take a partial and let the rest run. Keep running. Now, where was the draw liquidity? Well, this was the first one, and this is a higher time frame. This goes back several days of a short-term high. This was taken out. That's after that. You would have taken a partial right here and moved our stop to break even. Risk-free trade at that point. Longer term drawn liquidity was right here, which again was a long-term low. So that's where we were aiming for. Obviously we hit that target. But I want to show you why this was also a really good trade besides the fair value gap. It does trade beyond the fair value gap. So as we're trading this price comes through. Let me take off. When price comes up, we're looking for it to hit this and come down. When it goes through it, now we're concerned that, hey, is it going to act as support? So price comes up, stops here, starts here, comes up, taps that new week opening gap again, comes down and stops in close to this consequent encroachment, close to it. Price opens, it comes up, and then comes back down, and then stops in the middle. Once we close below this, we know that we're on the right side of the market, right? But we're taking an entry right when it comes back in because we're expecting it to go down. But why did it go up and stop there and come down? Well, you could say it stopped at the new week opening gap, and that's fine. But let's use another one of ICT's teachings, and let's throw a fib on there. When we throw the fib from the high down to the low here, we come up, and over here you can see the numbers right here. 0.705, the 70.5 level is right at this line here. That's optimal trade entry right here. So yes, we took our trade at the fair value gap where our stop loss is above the high of the candle, the first candle, and we still are fine. But we took some drawdown, and then we ended up winning, right? But right here, could have had a better entry, and we could have had, oops, wrong one. Could have had a better entry and could have entered up here. Our stop could have been here. One tick above. and our target down here. Now we have a 5R trade versus a 2R trade. Okay, so when price comes in through it, look and see, pull a fib and see if it's going to come and see if that's where it stops. It's going to give you another confirmation that you're still on the right side of the market. Let's say you missed this trade, okay? I'm going to take it off just so you can see something better. Say you missed this and you come back down, you missed the optimal trade entry, you don't see that. You come down, what's next? Well, there's another fair value gap right here. And it comes in and you could take that trade right there. You're still shooting for this and you're still aiming for this higher time frame draw on liquidity. So when you put that there, stop goes above the candles that started it. So it'd be above this one. I would go up here above the fair value gap because that gives you 2 PD arrays to work with. Okay. This right here is a 4.6R trade. Pretty good trade. But look at this order block right here. Just want to show you how precise. This is not an entry. This is not an entry. Just showing you how precise the candle bodies stop at, and then this one right here, this candle right here, goes up right to it and stops. It doesn't go into it. Goes right up to it. So that's a very powerful order block. It is not letting price come back in. Once it leaves price, it doesn't go back in. It leaves it. So that confirms it as well. So if I was taking this trade, once it comes down here and closes beyond that, I'm marking this on my charts to say, hey, listen, if it comes beyond this order block and up here, I want to get out of the trade because I don't want it to go all the way up and take a complete loss if it was going to go against me. You're marking PD arrays as you go through. If you wanted to keep doing that down here, you could take one here. Once price came up, if you traded down through it, it came up, didn't close about midway, and midway is here. It's about midway. Wicks go longer, but the body's relatively close. It comes back down again. This candle comes up, stops perfectly at the bottom of that order block. This is institutional order flow entry drill right here. Comes in. There's another trade right here. I wouldn't have taken it, but just showing you the potential once you learn these PD arrays. Here's another, 5, 10, how long does it go? About 9 handles. This is the very end of it. If you got in right at the bottom of the order block, another 9 handle trade. I wouldn't have taken this trade. I'm just pointing out once you follow the PD arrays as you're going down, you're looking to hold those to protect price from going up. So if it started to come up against me and go up above here, I'm probably going to look to be getting out. At least minimizing my stop loss, bringing it down to break even and leaving it there just to protect capital. It's all about risk management. So we're watching the PD arrays as we go through here. Same thing. This is another order block come through here. Where does it stop? Right at that new week opening gap. Once it comes up to it, stops, taps it, and comes down. Looking for it to hold price. You can follow this along as we go here. I know this is beyond this video, but just showing you price is respecting it as we're going lower. But there's your second entry. So you have the 2 trades right there. Throw the fib on there as well so you see. And just in the fib, when we had the low to the high, we took this where was our target? 1 standard deviation full. There was your 2 ticks below. There's your New York opening range trade setup.